You were listening to chartingwealth.com for Tuesday, the 19th of June, 2018. Everything is down for the day. The S&P 500, the Qs, that's the NASDAQ 100, TLT, 20-year bonds, and gold. Let's jump, as we always do, first into the S&P 500. Oh, and thanks goes out to everyone, particularly over the weekend, that bought our book, Charting Your Way to Wealth. If you don't have a copy of it, you want to understand everything we do here at chartingwealth.com. It is pretty much all covered there in the book. Please go to the website, look under our daily market reviews. You'll see a link there to purchasing the book, also a link to a video that tells you all about it. Whatever you need, we are here for you. Thank you also to all those folks that have ordered our trader journals. We've just gone into a second printing on those. We're into our third printing on the book. So that is the only way we've monetized this website over the years that we have done it. And we thank you so much for your support. Now, let's see what's going on the weekly chart. We have, as far as the start of the week goes, a breach in the weekly trend line as we look at the way that the week started off with our Heikin Ashi average pace candlesticks. We have broken through both the two-day trend line and the weekly. Now that is pretty significant for us. We see that the derivative oscillator is sliding sideways. Price percent oscillator is still heading up, but just barely. So again, a great deal of pullback here on the charts, a lot of weakness signaling with the new week that we are into. We look at the two-day chart and we see the first day of this latest two-day chart, some significant down move here. We ended that chart, the last candle on Friday, breaching the two-day trend line, showing us a red spinning top, almost a doji, of course, meaning lots of indecision tending down. Well, we saw that come into fruition with a strong down move on the Heikin Ashi candlesticks. Price percent oscillator losing energy and heading down, derivative oscillator losing energy. As we cue a little deeper into that and look at the 4-hour chart, of course, it crossed over going down back on the 14th. And then really strongly down on Friday and up a little in the afternoon on Friday, then down on Monday. A little bit of a recovery in the afternoon. Again, derivative oscillator gaining downward momentum. Price percent oscillator, we told you about pulling the plug and taking that nice gain that you jumped into somewhere around the jumping in point of about 273, 274, and of course reached a high around 279, almost 280. So again, a nice gain in about a week and a half or so period. Not bad at all. So again, that's the magic of the weekly vertical crossover when it is working. And again, we're in the summertime trading zone, not typically a great time of year to trade, but that was a great period. Now, what does it mean to you now that we have a rotation over going down on that 4-hour chart? It could recover. 4-hour chart could move back over going up before the two-day and the weekly crossover going down, and that, of course, mean you could get back into an up move. There's enough down movement. It might be a weekly vertical crossover in the coming days and might give us the potential for a down trade. We will let the charts guide us because we are trend followers. Now to the Qs, the NASDAQ 100. It is continuing as far as the weekly chart goes. We still see up movement. The latest candle, nice movement above the two-day and the weekly trend line. Derivative oscillator moving up. Price percent oscillator moving up. Not quite at the same strong angle, but still moving up. We dig a little deeper into that first day of the latest two-day chart. It is flattening out. We do see a doji forming. Now again, the candle hasn't penetrated the two-day trend line, much less the weekly. But we do see the derivative oscillator losing some energy and the price percent oscillator not heading up at the same strong angle. We look at the 4-hour chart. What do we see? Well, we talked about that last week in the afternoon, crossing over, going down. We saw more in the morning, a little bit of recovery in the afternoon, but the derivative oscillators heating up, going down, and the price percent oscillators going down. Again, you can sure stay into this until you have a penetration of the two-day trend line, if indeed that occurs. Again, it's up to you depending on what your experience is with the Qs. And again, that's why you need a trader's journal, or you at least need to print out our trade worksheets, our daily market and weekly market worksheets, and learn how each of these ETFs or any of the stocks you follow they all have their own personalities. They all trade in their own ways at certain times of year, in certain seasons, and in certain economic conditions. So it's worth keeping up with these things. Now, if you are simply going to go by the rules, of course, when you see crossovers going down and you see the weekly vertical, and I'm sorry, the 4-hour derivative oscillator and the price percent oscillator crossing at the same time, and that's a strong enough signal for you to pull out, then of course you can do that. If you're waiting for more penetration of the 2-day trend line, strong candlestick support, that's something else you can look for. If you still feel comfortable with where the 2-day is and the weekly is, of course you can stay in. And you can always wait for a rotation back over going up to jump back in. So we'll just continue to watch and see what we see. But the Qs looks a whole heck of a lot better than the S&P 500 at this point. Okay, what's going on 20-year bonds? Remember, we had a weekly vertical crossover going up back on the week ending the 25th of May. We followed that by a strong week of up movement, then a very questionable week of movement. A doji, a red doji, means lots of indecision tending down. Then, of course, this prior week was not a doji, but was awfully darn close to it. It was a spinning top, a green one, meaning indecision, not as much as a doji, but tending up. And of course, so far, we see a green candlestick on the Heiken Ashi candlesticks. And again, they're calculated differently. Even though TLT was down for the day, we have a green candlestick forming on the weekly, derivative oscillators heading up and the price percent oscillators heading up. So pay attention to what's going on TLT. It is still confirmed up move on the weekly. Now, what do we see on the 2-day? Well, it's confirmed up also. Derivative oscillators losing momentum, but the price percent oscillator, our primary indicator, is heading up. And we seem to be going into a second, and again, it's just the first half of this 2-day candle on Monday. We do see another green up candle forming, so keep your powder dry and watch things. What's going on that 4-hour chart? It is the derivative oscillators losing a little bit of energy, price percent oscillators trying to stay up, but we have 2 down candles, and again, for the day on Monday, down 0.11%. So just watch things and see. May portend a crossing over, but again, those bigger charts are telling us TLT's trying to move up. So just watch yourself. Pull that on any kind of percentages that you've decided. If you're a 10, 20, 50 type, if you're looking for 10% down and out, 20% up and out, then of course if you've got 10% movement down, you might pull the plug on things. But again, at this point, price movement's still above the weekly and the 2-day, and you don't have a crossover going down on any of these charts yet. So watch things on 20-year bonds. Okay, back to the weekly, and we're lastly going to gold. Gold down 0.18% for the day. Gold's been in a confirmed down move since mid-March, and of course, since things started rolling over going down on the week ending the 27th of April, we've pretty much had fairly consistent down movement, a couple of weeks of some up movement, never pierced the weekly trend line. So we see, again, starting the week off with the derivative oscillator gaining downward momentum, price percent oscillator heading down. Look at that 2-day chart. Big down candle for that on our Heiken Ashi candlesticks. Derivative oscillator really gaining downward momentum. Price percent oscillator headed down also. And of course, we look at that 4-hour chart. What do we see? It could be bottoming somewhere around the 121.14. If we look back, do we see anywhere within the last few months a floor there? And of course, that's always good to watch. Maybe a floor somewhere around the 120.31, but we'll keep our eye on things and see what we see as things develop in gold. Could be, again, just be careful. There may be a floor somewhere around the 121 mark. Keep your powder dry and pay attention to that. Folks, that's where we are as we end the day on Monday. Go into Tuesday the 19th. If you've not ordered our book, Charting Your Way to Wealth, please do so. And also, 3-month your trader journals for 3 months are available. Basically, an entire quarter's worth of journal right there, 4 of them for a year of trading. Please go to the website, check out the trader journals we have for sale, our books. We also have videos on each one of those. If you've already subscribed to our daily market review, it is always in those. You'll see the links to everything. You'll see them under our daily reviews posted at the website. You'll also see the links at our YouTube channel. Please subscribe to the daily market reviews at chartingwealth.com, and also subscribe to our YouTube channel. God bless you, friends. All the best from the whole team here at Charting Wealth World Headquarters.